Hi everyone, happy to see you today. Today is our third session for Innobooster program, and we are speaking about venture world, venture industry, money and investments. So probably it's one of most exciting lectures. I try to make it entertaining, but also useful. So there are some maths involved, but there is also some memes involved. And you will see, you are free to interrupt me whenever you want, because I want to make it more useful and tailored made. You know, I want to ask your questions particularly, because many things of this are obvious. You might know this if you are already in this innovation path for a long time, but maybe I can give some more insights. So let me share my screen. And we will start. So venture, can you see, right? Let me just a second. I want also add your question so I can see if you raise hands. Please interrupt me because I cannot see all of you, right? I can see only the screen. But in case you want to answer or question something, just ask. So today we're speaking about venture capital. What is this VC? How does it work? And actually who we are and what we can do for you. I'll start with brief introduction. Many of you already know me. We had conversation with 8 startups from the batch. So you might know whatever we do. We have a portfolio of 88 startups that we accelerated during the last 3 years. Before we were also investing, but now actually we are just delivering like educational program. We have our mentors all over the world, and I will come to this point. Like Marina sitting is in Miami, and you will see Sana who is sitting in Krakow, and all of them are at your service. So speaking about us, our people all over the world, and before it was only mentors, now we have level up, we have even startups all over the world. So basically we are totally digital structure. And here you see our picture from the last World Summit last year, where we actually gathered together, we connected, we had some great time together. Despite or besides the startup acceleration, we work also as a corporate innovation provider. What does it mean? We work with corporates. We see how they select actually startups, what do they want from startups, and we try to connect startups and corporations to build partnerships. And third service line, we also accelerate startups through venture capital deals. Basically, we're fundraising for them, help them structuring deals, and that's why I'm here today to speak about it. So the idea of acceleration started actually almost 8 years ago when I was traveled to Silicon Valley and attended Stanford University and met Guy Kawasaki. I was lucky to see like many icon figures in Silicon Valley. I didn't think that about acceleration that it will be serious stuff, so I was just exploring. But in fact, several years later, in 2018, we decided to run our first program, and it was quite successful. So I'll just show you who were before you here. Yes, some Ukrainian startups, and just go on briefly. This is a bunch of our mentors, so from previous programs. So, and now we will come back to, oh, Adrian just joining. So in Ukraine, we actually have a big community. Now it's like worthwhile community. And we are happy and we want really to make friends with you. So make sure that we will stay connected even after the program, right? To support each other, to share information about grants or some kind of tricky stuff. For instance, if we decided with you to create a blacklist of venture funds, right? Whatever might be happened. So you might have read information about me, or maybe you can go to my LinkedIn page. Just I'm leaving this in presentation. Make sure that you just guys switch on, please, your microphones. I see some noises here, right? I think Lucas can answer. Okay, perfect. So let's come to main topic. This is what I want to cover today. So I will briefly done introduction. We will speak now about different types of funding, important questions that you have to answer yourself. We will speak about profiles of different VC funds, of how to approach them, your financial visibility, how to communicate yourself, and many other negotiation tricks as well. But from the beginning, I want to see some hands. How many of you are planning to fundraise in nearest future? Can you please using those emojis? So I see Alexandra Samokhina, so Technotable is looking for finance. Anyone else? Two hands. And other guys, where are you looking? Like, do you want to bootstrap, or what is your strategy in respect of financing? Can someone who is not going to finance just comment on it?
Yeah, Elena, sorry, I wanted to raise hands, but I can't find the icon.
Hands are below, you know, hands in the
in the reaction, there is like a
reaction. Thanks.
So because I really want it to be practical and more useful, so that's why it makes sure like who is raising us, how much you want to raise, where you should go, how we can get support for you. Oh, sorry, I just wanted to see. So those are my questions now. What we are trying to answer during this whole event. Okay, let's go. So basically, when some idea occurred to you and you decided start up, the first idea is just where to get money, right? You have your team, you have idea, you have maybe some technology, or you have some patents, innovations, or whatever, but you need really money, just at least start to run. There is different type of financing, right? Non-dilutive funding, just when someone sponsor you, like government give grants, tenders, some foundations, sponsorships, anything like all type of funding that is provided by usually either by government or by private organizations who support innovation, ecosystem, or any type of innovation, right? But most of people who give you money, they want something back, and they actually asking for equities back. This is everything, all of them, private equity firms, angels, VCs, corporates, even corporates who have enough resources, they still demand sometimes too much. We will speak about them. Family offices, investment groups, any types of crowdfunding, they want something back. There are different practices how to actually understand whether you need money or not. But you always should be aware, if you're taking money from someone, you give them equity, you give them right to influence your business and your life, to be part of it. And you should decide whether you want those people to be with you on early stage, or maybe you try somehow to do it by yourself at some point. Oh, I understood how to edit. So what to expect? For no dilutive funding, I think many of you already worked with them, something like grants and programs by Euro Commission and so on. In some respects, it's really great because you have your project with you, but it's too long. It might take 2 years or longer, you know, and you're waiting, and there is nothing come up, but you have to actually grow, right? You have to develop your research, you have to go to the next stage. For dilutive funding, as soon as you are taking someone to your project, they already becoming part of your team, or not even team, because they sometimes do not bring value, but just picking your brain, right? If you have done not smart money. And they come and they already can have some point of control over your rights, and they actually already asking for return, but maybe if you're in a tech startup or biotech startup, and sometimes for such kind of innovation, it takes more than several years until you will be somehow monetized and will have some finance returns. And also you can have some debts, but the point is, unfortunately, that in Europe, banks are very reluctant to work with startups, right? We know many cases when banks are interested to work in startups in US, but even now it will be more risky, as probably most of you heard about the trouble with Silicon Valley Bank, and both suffered, and bank and startups who had their finances. So it somehow shows the slowdown of the industry. But in this presentation today, we are going to speak mostly about venture funds who are ready to support startups. Venture funds, some corporate funds that also might be useful, and actually angels, because they in many respects are similar. So could someone please give me a definition of venture fund, what it is? Just how you understand it, whatever. How you see those people.
I can try, because I really don't know exactly how it can explain the right way, but my opinion that the venture capital is the investor in its company, or maybe private investor who gives the money for the early stage of business startup. And most of them buy startup, not buy part of startup, get a partner for the main idea to make exit for some time, and to grow up their money of this way.
So basically, Alexandra, you told everything that is written in Investopedia. So it's perfect, and you covered all. So guys, just repeat, can you see it? Because I see your faces and also my screen. Can you see the whole presentation, right?
Yeah.
Yeah, okay, perfect. Yeah. So venture capital, form of private equity. So there are several forms of finance. It could be private and it could be public. So everything that's done through the funds is private funds. Public, it's when we are going to IPO, initial public offering, when we are going to stock exchanges. And also financing could be divided into debt or equity finance. Debt actually is like loans from the banks, and equity is when your investor is going to participate in your project, taking part of equity, and I don't know, 5%, 10%, or whatever. Usually it's small percentage for venture capital funds, and usually big for private equity. Private equity means someone who invests in traditional industries like manufacturing or whatever, and they usually take like 15, 20% and so on. So they're going deep inside. And it's crucial sometimes to understand the difference between private equity and venture capital funds, because by nature they are very similar. But what's happening in Europe, and this is very different from American industry, that in Europe, venture capital funds sometimes behave like a private equity. I will tell in details more. And in United States, venture funds, they really invest like a venture. They understand the risks. They understand that there is no predictions. They just listen to the pitch and they can give you a quick paycheck. And I've seen this many times. So the cultural difference is really big. And this is one of explanation why somehow United States can grow this ecosystem more quicker than we here. But it is what it is. So in some way, we as a startup, as ecosystem builders and ecosystem providers, we are also educating venture funds how to behave. And today we will speak about bad venture funds, good venture funds, how you choose venture funds, not like only you have to please them, right? They also have to be accepted by you. Maybe you don't like them. It's like both ways. Now we will go through some classical stuff, right? Stage by stage. I'm sure that all of you have seen it. Can you just give me some signs whether you're familiar with this structure, startup financing cycle, how deep we should go through it? Let's look together, right? So what does it mean? It's classical information, how actually venture industry built, right? So looking in the first stage, we have just seed startup, and usually friends, family, pools like FFF are going to finance it, either some government and universities. So it's like an idea stage, seed and prototype. Usually it's hard to find finance. Possible, but hard. When you already gathered in team and you have something to show up, some business angels, angels groups, angels association might be interested to you. Like those super risky investors, right? Startup and other early stage startups. So as we are progressing, having some tractions, developing product, making MVP, going post MVP, looking for the early clients. So we are growing and we are becoming more and more attractive to venture capital of early stages. There are different type of behavior for venture capital funds on early stage and on later stage. So early stage, they basically understand that you are still very early startup. They understand that it's hard to make some precise calculations of market, precise understanding of your financials, of your business model. Yes, they do ask you about it, but they understand that it's too early. Maybe you are still in the process of customer development. You are still looking for your business model. You don't know yet what's gonna be. They are just mostly look at you as a team, as a personality of founders, and they trust in their own intuition and experience, decided whether to invest or not. And you see in states, those rounds, they really can amount something like from $1 million or even more. Here, I would say early stage, they tend to give lower amounts, or another way of financing, they afraid to go alone. They don't trust themselves and they go in bunch, bunch VCs. They create a syndicate for one deal and you have this million, but from 5 or 6 or 10 investors. It also could be great because it's already like a real round of financing. It's your way to start up life and you're becoming famous in this moment when several VCs join just to back you. Later stage venture capital, they already more serious and more behave like a private equity because now you are already company. Maybe you have 50 employees, maybe 100 employees. You already have revenues, you have employees, and you strategy, financial model, and then they start classical stuff as due diligence. When you're going round by round, you guys always have to be to keep in mind several things. That round by round, you are more and more diluted. It means your shares or your shareholding as the main owner is becoming less and less, and you're letting new people come into startup. I need some reaction from you for whom this information should be going deeper. Maybe you have some questions in this point. Or
yes, actually
please,
have.
Please. It will be easier for me to make direct answers.
Yes, do you have any assumption concerning how much equity we can share, for example, on business angel stage or early stage, later stage, and public markets?
Yes, it's a very good question, very smart one. I will tell you why. Because your task, I would say, you can guys have different strategies depending on how you gonna run your startup. And as for me, as like person who's seen different situations, I would say even bootstrapping the whole life and then going public in the very last moment, it's also a good strategy, You can skip many turmoils if you decide just to bootstrap and then later on just take some private equity. You don't have to do always all those stages. And your mission or your, let's say, target as a founder is to be diluted as later as possible. So if you can get some funding in the beginning and don't give big equity, it's better for you. For instance, I would say in Eastern Europe, angels can behave differently. So some of them require 5%, some 15%, and some old-fashioned people like coming back from 90s, they can come and already answer demanding 30% or 40% of equity. I mean, we've seen those situations in Poland, we've seen them, of course, in Ukraine. I'm curious whether you've seen such people in Hungary, maybe, or Czech. I mean, guys, you react because I'm curious, really, if you know, if you ever heard it. But there are some people that, oh, yes, we will develop your startup, give me half, you know. I mean, this may be the case. You can agree with, you can take them as a partner, but then you just should bear in mind that it will be quite difficult for you to go through cycles, because you will be diluted more and more and more. So frankly speaking, you will lose control quite quickly, right, over your company. And the main motivation for the founder to keep it. Just speaking about this table, I will skip a couple of slides because it's answering Ruslana's question. So I developed here such a thing like cap table, right? Cap table. So you know what it is. Capitalization table, it means actually who owns how many shares, right? So this is typical stuff that you should be aware, and your motivation. I mean, in the Zoom, I have too much tables, it's hard to show. So let me maybe show this one, this example. I hope you can see it. Just some imaginary startup, right? You see shareholders in the beginning. The situation was like this: Joy, Jen, Cindy, Adam, Chris, Tara decided to run startup, and you see they had some common stocks, right? When they created first legal entity, they somehow divided the shares, right? If you will calculate those 100 to 1,200,000 per 5 million, you will see that Joy CEO in the beginning had 24% of shares, right? After actually allowing investors, Series A brought them 5 million, Series B brought them another 3.6 million. So they, in the end, have 13 million in equities, but their final, let's see, at this point, shareholding is only 8% for the Joy, right? So our shareholders, like 5 people who actually run the company, they are now having something like less than control package, right? They have something like 30%. And it's not the final one, right? They may have series A, B, C, D, E, and so on, right?
So,
Depending on the situation.
may I ask question?
Yes, of
If you can see that one investor on the Series A and also on the Series C, he invested 5 millions total. He received like 18.3% for that.
Yes, but it's every time it's recounted. Yes, because yes, he requested once, 2.5. We need to calculate it. Basically, calculation goes like we calculate DIN divided by the total amount.
Okay.
Yeah. So like this, a just example how you are being diluted on every stage. The more investors you go take, the less you have. I think I didn't check for Zuckerberg how much he has as of now, but as I remember that Bill Gates was having something like 1 or 3% of Microsoft, you know, in the end. So something like really, really small percentage, because there were many funds, many investors, and so on. So it's curious to see those big companies, which small amount of equity actually founder has in the beginning. So that's why I actually urge you to be careful from the beginning whom you want to take. Let me go to this slide again where we were speaking, right, in the early stages. Now what I want to go and just tell more about Ruslana's question. So it happens so that, for instance, in Europe, accelerators tend to support ecosystem, Euro Commission tend to support ecosystem, Visegrad Fund to support, and they support accelerators to provide those knowledge to the startups, and we don't take equity. So this is in a booster equity-free program. But for instance, when we send our startups, and we do send them to the United States just to get some expertise, to get some knowledge, and they send us agreements with accelerators, they already want to take something like up to 15% equity. right? But it's the only accelerator. It's not even venture fund, and they invest something like, I mean, really small, like $40,000, right? And you already given 15% equity. I wouldn't say that it's a good deal, but it's very, very popular stuff. That's why I'm urging you always to read and to make sure how much you're giving up, and make sure yourself, are you ready for this or not? Do you need those 40,000, for instance? It's like startup ventures. I mean, I know those accelerators, or maybe you can survive without them. You always going round by round, it's always trade-off. You're thinking, do you need those money, or do you better keep those equity for you? So it's always like this, you know?
May I ask a question?
Yes, of course.
Let's say if we talk about the business angel around from 100,000 till 1 million. If you talk about the 1 million, what is, on your opinion, the percentage relevant for 1 million?
I will ask. So now you are basically, we are coming to this most tricky question in the venture world: what is valuation? So you may believe that at this point, when you are negotiating this deal, your startup is value 5 million, and that's why you can give them 20% for 1 million, right? And they can try to prove you that you're worth nothing. I mean, it happens like this, right? It depends on the expertise, the standing of the market. It's always negotiable. And at this point, when you just work with angels or some kind of family offices in early stage, it's very hard to prove that you actually worth those money. And there are some tricks. For instance, if you go fundraise in Europe, you will get for the same startup one valuation. For instance, I don't know, 3 million. If you go to UK, as UK is more, it's probably the most powerful venture ecosystem in Europe, right? With money-wise, you will get for the same startup higher valuation. And if you go to New York or to Silicon Valley for the same startup, you might get even more high. So the valuation also depends not only on quality of your startup, but also where you fundraise and where your expertise of those people who are going to invest, and also on the liquidity in the ecosystem itself. You see, that's why I would advise stage strategy. If you're already thinking to fundraise or speaking with some angels, try to score several investors and see what they're giving you, right?
But okay, if you talk about 1 million for 10% shares, that is a good deal on your opinion, or not a good deal?
I think in the early stage it's perfect, you know, because it's like you're valued, right, at 10 million. It's already very good for startups, for any kind of European startup at that stage. Basically, they actually even behave not like angel investment, but like early capital, venture capital fund. I mean.
Okay, and let's move, if we talk about earlier stage venture capital fund. If, for example, the deal 5 million, which the percentage could be good for such a deal?
The less percentage you give up, the better, of course, right?
15, 20.
15, 20. I will ask you about what is your criteria on how it's behave, right? It's very different for different industry. I'll explain. For instance, biotech industries or medtech industry might need this money, but they might not making revenues yet. But if we're speaking about gaming or about any apps, more likely at this stage, apps already making some money. They have subscriptions, they have any other types of revenues income, and more likely they're already profitable themselves. You see, that's why it's much easier to give them money, because you see that they're making money, and they sooner or later will be able to give you some returns. So they're in a safer place. So this is very much dependent on your financial modeling, right? But it is possible, even on those stages, to raise some money without revenues. It happens. I mean, in Silicon Valley, there were like they given hundreds of millions. For instance, this famous case of Tyrannus, we discussed it, I think, with Tomasz Kurhanek, right? What was this? They were fundraising like crazy, but they were not making money at all until they reached valuation of 10 billion USD. It's not normal situation. It's like because like many frauds occur and so on, and it's like overheated market, which is not going to be the case now, as we're going in another cycle of economy. So coming back to your question, 5 million for 15, 20%. I mean, it depends, you know, if you wanna make your money, if you see that those are money are crucial and you don't need any fundraising for, I don't know, 2-3 years, it's one situation. If you see that you take them, you burn them or you invest them and you need again to fundraise, then again, you are prepared that you are being diluted, you are giving more and more. And also don't forget that on next stages, your previous investors, they also influence, right? They are being diluted, they're excited or not excited about new investors coming. So you were creating kind of internal corporate conflict with more and more investors.
Okay, thank you so much.
Any other questions? Because I want, you know, don't want to make it just like dry presentation with classical stuff. You can read it and probably I'm sure many of you have seen it, but maybe it can be tailored exactly to your startups. Just a second, I'll take, Sasha, you go ahead, you ask. I'll just take some. Ask, please.
I want to ask about that question that you tell previously, that when the startup is the early stage, is the prototype and seed stage, we really check the market, we really can change in nearest future the business model, we can make a pivot, and etc. etc. But we work, for example, in our example, we work for one market for 3 years, yeah, and we understand quite good of this market in one area, and we can implementation this 3 years, yeah, and the results that we achieve for these 3 years for another market, but it doesn't work. Unfortunately, yeah. And the one way we have a lot experience, enough, not a lot, but enough experience. But if we talk about worldwide working, yeah, and worldwide startup, unfortunately, we are not experienced as well as we really can prognose the marketing activities in the right budget, in the right way, because they use another, for example, channel, they use another many things, and we understand that it is another business. In the same time, it's the same business, and how can we be on this way?
And what's the question regarding investments? I mean, you should survive. The answer is if I right understand that why the investors, business angels, and etc. Are not a lot invest in the early stage, because they understand that it is a long way, yeah. And when we have a long way, but we check the market, we go for another market, yeah, and it's another way, and how we can build our I understood the point. Actually, yes, that makes sense a lot. That the earlier you invest as investor, think as investor, right? The earlier you invest, the longer you have stay until some returns. And I even created this table. You can see angel, they invest, and their typical holding periods is like from 8 to 10 years until you actually exit it with some returns, right? I mean, it's long. I mean, it's easier to buy something and sell it, right? Seed round, and you can see investment size and holding period. Those two graphs, you just check. Seed round, usually it's something like about 6 years. You're waiting until you can exit. Growth stage and then crossover next stage, they are shorter and shorter, right? Because it's already company, you see that it's growing, it's progressing, it's more stable, it's easier. And you can see also expected rate of return for investment. So angel really expected like at least 3x, 5x or whatever. Yes, they really want some several times multiply their investments. seed round can be more moderate in the expectations, and those funds who are coming to later stage, they already would be happy to have some 30 years annual interest rate, and they are fine with this. So this you should be aware that everyone invests where they understand, and if they don't understand your industry, or you see that you are a foreigner, or you see that it's not their market, they tend not to invest. You know, there is nothing you can do with them, right? Investor types also, here we can check. You know, those are most famous examples of different type of investors, just for you to differentiate, to know what the difference between and how they do invest. Like accelerators, they invest in mostly Americans ones, right? It's like individuals, a group of individuals who invest. And they actually, in the United States, they can finance up to $500,000 in the early stage. In Europe, I think most accelerators are more modest in the investment. And then early stage professional investment comes. And actually, like some names of them are quite popular. Later stage is mostly private equity. So they already making classical stuff, due diligence, examine your business, going back and forth, all legal agreements. So there are some terms that I wanted really to make sure that you know. Yes, who knows what is valuation for startups? So who can explain in your terms how you would be valued?
Check if I write no, we check for two ways. The first way, we can evaluate our startup for the revenue which we get, or net, not maybe revenue, for net profit. And if we get a net profit, we can create valuation by the net profit for the different product, for the multiply for the different years. It depends on product. It's the first way. The next way, the stage when we didn't get a net profit, we can check for the future net profit and create the valuation about that. And the next step, we can evaluate our company for the grow as like another company in this market. We can check the Crunchbase or some different research and find the startup with the same solutions, and can check the deals on the market and suggest the same or the less, or it depends on our expectation.
Just who guys tries to evaluate yourself? Did you ever come up with ideas how much you can cost? I mean, you should create some expectations if you're going to fundraise, right? So make sure that you were thinking about it. So who have ever worked with shareholders agreement on share purchase agreement? I mean, there are some legal stuff that you should be aware of when coming to fundraising, because if you're just signing what investors shows you, it's not always what you expect, right? And you always need to have some legal support or legal advisor who actually protects your interest. And when we are creating loan program, we're trying to go through all those documents to make sure that founders know how to protect themselves. What is shareholders agreement, what is typical SPA, what's supposed to be in term sheet, and what your requirements you also have to put there. Have you ever tried to undergo due diligence process? Who have ever been checked? Maybe in previous project, not in these startups, maybe in your life, when basically investor comes and they totally interrogate you, like they have a rigorous investigation of your business. They look at legal stuff, they look at your performance of your KPIs, they try to check how many users you have, and so on. Have you ever experienced this? Yes, Naomi.
Maybe not like straightforward, but I was participating in the meetings with the investors up till like term sheets and then all the negotiations and things. Tough.
And
Tough.
how was your experience? Did they behave correctly? Did you like it? I mean, just some emotional experience.
Yeah, it wasn't the project that I'm doing now. It was different one, but in general, it was like a lot of money on the table. And in general, it's just tough. It's very tough because each side fights for their rights and try to, you know, find a common ground. So negotiations are sometimes, you know, almost you are almost dropping it because they are too, they don't want to agree or things like that, and you feel like they want to drop it because we were too high or something. Yeah, so even the emotions needs to be well expressed, not to scare other party.
And can you tell us a little bit how was the gap between expectations? Because in my case, I will just tell you one example. It was actually a traditional business. It was huge hotel business when we were working for acquisition, and expectations of sellers was like 150 million, and the proposal from the buyer side was like 10 million or something. Can you imagine the gap? And can you imagine that both sides are interested in transaction, but they're fighting between themselves, and you should somehow prove your point of view and find this middle point where you can shade.
Yes, so here the gap was actually on the table. It was 25 million in dollars in USD. It was a huge project. It's telecommunication on based on nano satellites, but the company, and I'm not saying that I was on the C-level even. I was participating and as a VP, but not like fully there. I was just hearing that. And the expectations were that they will take some percentage, probably some bigger one because of the money that they are going to put. But what happened, they actually took over the company, and that's what happened. Like they, on the end, the C-level people, they agreed for it, and it was just, you know, the investors bought out the company with higher percentages that they didn't have any more rights in it.
It's a really great example, you know, because it happens a lot, and it also can happen with startup, you know.
Yes, but they had to do that because otherwise the company would not survive for sure. So they were in the really tough spot in that case, and they said, okay, if we will not get it, that's it, we will not survive. So decision was made.
You know, the point is like we go into another graph, but very similar, right? For startup financing cycle. Like in the beginning, when this valley of death, you have to invest so much your emotions, and you're creating this company, you're building it, you're sacrificing your personal life, your all belongings, whatever, you're trying to build a company. When you're profitable, or at least you're a growing company, maybe even not profitable, but you are growing, right? You can sustain. Investors come and they can actually already either make it in favorable proposal and buy it, or maybe sometimes even make it like real tough and buy it. So, and you are losing your company. So you guys always should be aware, like when you're taking investors, about your equity. And in another case, I will just remind you, it's like famous last classical case of Apple, where Steve Jobs was kicked out from this company because he had just several percent of equities, and actually the board of investors could fire him at some point. You remember this, right? So you invested your life, built the company, and then you are just gone. I mean, it happens. So that's why we encourage startups of how to be aware of situation and to use your equity wisely. So I think here we're more or less done with this part. If any other questions, or maybe some unknown things, just ask me. What's the difference between early stage, later stage, how you should be prepared to IPO. One thing that I always want to advise to startups, keep in mind your exit strategy. At what time or at what point of business development you are gonna leave. I mean, some of you really want to become unicorn when the business model allows. But if it's not, maybe it's perfect to leave it even with 1 million euros, right? And start over a new business, or maybe with, I don't know, 5 million. Or maybe you want just to manage it and to be like chief of the board, and it's okay also. So you always should think how much you want to sacrifice, or and when, what's your strategy? Like your personal as a founder and the strategy for the company. Maybe it's okay just to sell it at some point if you see that the market will not allow you to grow the company, right? Or maybe some situation or stagnation, recession. So many things can happen, and instead of just dropping it, you can at least sell it, right? So it's also some things just to bear in mind. Okay, now we will go back to VC's logic, right? What is VC basically? So we see just some basic scheme, like every fund consists of general partner who is actually managing the fund, and some limited partners. Limited partners, it could be pension fund, it could be some institutional investors, corporates, whomever, right? All of them trust general partner, they give him money, and actually he manages, he decides on transaction, on deals, and he is responsible to make some returns. So he is creating portfolio of companies. He invests in 10, 20, 30 companies, expecting that sooner or later you guys will grow and make returns. And what happens with venture business? What's the percentage? How many companies survive? Approximately, who have heard it? From 10, just make a guess.
1 or 2, maybe.
1 or 2 will grow. Maybe 1 or 2 will be at least more or less stable, and probably 6 will collapse, will die at some point. So they really have to find those pearls and trust in them to make sure that some of them will grow and make such returns that they can cover all other investments, right? Because they're responsible somehow to deliver to their limited partners. So this structure understands the logic, how they look at you. That's why they are sometimes so tough, so rigorous, so inquiring, demanding, because they are trying to make sure that they will be able to return money to their limited partners. So the logic behind the venture capital is like they fundraise. First, they ask limited partners to give them trust and give money. Then they invest in you, in different companies. Your companies grow, hopefully. At some point, they can exit, probably in later stage, Series A, Series B, if they invested in seed, or later on, right? If they invested in Series A, maybe they can wait for 3-5 rounds and then exit. Returns, they can reinvest, and so on. This is the basic cycle, yes, just to understand it. So here are some terms, what they do, how they source. I don't know, maybe you spoke already and you have expertise with some venture fund. If you know, so if you don't, their basic work is really just to source for the deal and to interrogate and find those pearls that will cover the whole portfolio. If you want to add or ask something about venture capital, you please go ahead. If no, we'll go further. There are several approaches how to work with VCs. There are roles in VC, right? Basic, typical venture capital fund consists of analysts, associate, principals, venture funds, and general partners, like venture partners or principals. And some people recommend just write analysts, write associates, try to build contact with them, just bring your attention. Usually those are people who attend a conference and so on. As accelerator, we prefer to know that we knew fund exactly who is behind him, who is the owner of fund, who general partner, and we are trying to investigate the fund, even whether they worth or not spending time on them. So if you are going to fundraise in future, try to build your network of venture fund, at least you know with whom you want to approach. Otherwise, you are just sending your numerous proposals to 100 funds and get no reply. Did you ever try already to have this cold emailing with venture funds? Maybe some of you. I know that Alexandra tried many stories like this? Can someone share your emotions or your experience?
For example, our startup, we started to for looking to some investors, angel investors or VC 1.5 years ago. Just reading what they need, so I write some pitch deck and write some proposal, and it ended up in analysts that they are not interested in our startup. Anyway, when I got into that analyst, I got into also the more senior level, where we realized that what specifically they invest into, and that our startup is out of their portfolio or what they're focusing to, and they would probably invest in our company if we prove that our idea is validated. So we got some significant revenue from customers.
Yeah, that's what they usually
So,
tell. But it's great that you've done your homework, right? You first of all understand that they're really looking for numerous startups and they can reject. So the point here is, don't be disappointed if you have some decline or some rejection, because sometimes you have to approach 100 VCs, and then it happens so that you see this VC 3 times, they rejected you 3 times because analysts didn't understand something, and then you come to general partners and say, oh wow, it's a great idea. So just be aware of the roles with whom you are speaking. Yes, don't be disappointed if something went wrong with someone. Maybe you'll see another person with another role in this VC, and then your deal come up. Let's go further. Other participants of the deal. One more task, I wanted really to go through these terms and make sure that you guys understand them, right? Again, so term sheet is your proposal by VC, what they propose you, yes, like 1 million for 5% or something like this. Oh, we have another friend. Actually, guys, Attila is joining us. He is from, I think, Startup Campus Hungary. If you want to go to Hungarian market, you can speak with him, because I know that someone wanted to go to Czech market and someone wanted to go to Hungarian. So please, Attila, welcome to our session today. So due diligence, now I may explain what is due diligence very well. Yes, it's exciting experience and basically full examination. Yes, like going to proctologist. I'm sorry to say it, but really they're looking everywhere too much. And this what you always have to undergo on the later stage. Investments round, we've seen cap table, more or less, it's clear, right? What is cap table and how it's washed out. And you have to always recalculate how much influence is left with you. Well, let's see, other participants of the deal. These are like shadow partners, your friends, like for instance, lawyers. You know, if you already go into the deal into a later stage, more or less you should be aware of many tricks that are there. There is a great Estonian movie called Chasing the Unicorns. It's a movie, I think, 2 or 3 years old. And basically it's about Estonian startup who gets some investment from American fund, getting $5 million. And the story is there that, I mean, there are some tricky points when Estonian lawyers negotiating with American, and they lost several clauses in agreement. And the end is that the company was taken over by the fund and the founder was kicked out. But I mean, it was really like learning. It's great learning, yes, to see what tricks lawyers can put. And if you are an experienced founder, and most of us are not lawyers, right? It's great really to have someone who can support you during this deal and to find those kind of things. Who else? Yes, participants of the deal. So previous investors, they always have opinion, whether they want to take new or not. They might prevent from the deal, or they might, again, even go to the next round and give you more if they really like your company, so they can refinance you, add more financing. So make sure that you are not involved in new people. Your co-founders always have opinion on next round. So every time it's a round of new negotiation and negotiation. Maybe your co-founder against investors, but you want them, or maybe your co-founder already so burned out or worn out that he wants or they won't just exit the company at some point. So there are many things to consider, and if you're speaking about this venture trip, there might be many hidden rocks in the water. Let's see what else you should be aware of. Knowing your partner. Let's say like this: not all venture funds are equal. Some of them have expertise in your industry, some of them not. Some of them have good intentions regarding startups, someone don't care, right? And you are really desperately looking for funding, for money, and there is a chance to take a wrong investor. Either investor might be dumb and they don't understand your industry, but they're already demanding something from you, or they just cannot help you, because there are investors who can really open your, giving you contacts, open your markets, somehow can be valuable. There are some that just don't care, you know. So you always look at the profile of investor. You have to do your homework, you test them, and you check whether those people are really so great, and if there are those who present themselves. Just I will switch 1 second. So there is some kind of due diligence that startup also has to do on investor, right? Just don't accept money from some weird people, because then later on you cannot kick them off and you are already depending on them. And it happens also. It happens when the people present themselves like investor, but they are not, you know, or they don't have expertise or experience in your industry. So that's why you go, Alexandra had this experience, right? When someone told you that they're investors, they are trying to invest, but actually you've checked and they are not. They've never invested in the medtech tables, and they didn't have some proper profiles. You cannot find information on them. You cannot find where origin of the money for, you don't want some strange money, right? You want to make sure that they appear like in proper way, because venture fund can take, I don't know, some kind of money laundering or whatever. You need to understand where you're taking, or what kind of money you're taking to your startup. So you are how analyze investors, right? You are analyzing them by their previous experience, by their deal floor, what industries they invest, by their exits, how they grow. You can have some recommendation from other startups who are in their portfolio, whether they are valuable or not, whether it makes sense to them to work with them or not, whether they help their startups to grow. You can check their profiles, right? Website, Crunchbase, other type of profiles. You are just checking who are they. Of course, you're asking them what else, why they invest, what kind of startups they support, their motivation and their experience, and what kind of funds they want to build. So, and again, coming to this point, it's always like more exciting, and to understand that venture capital is all about networks. You know, you should know the people way before you are going to take their money and they're going to invest. So you can to do your homework, like numerous emailing, messaging, so on, so forth. Maybe some of them will pay attention, maybe not, but also you always participate in all potential demo days and pitch days, right? To meet investors, to build some relationship with them. We advise to have like your own table with all investors that you met, their reactions, contact, day of contact, and see somehow like your traction of communication with them. I think one startup here, I believe it was Vladimir Storzhuk. He is not here now, but it's in acceleration. He is here with us. So he showed me very well prepared table with 50 investors and grant programs that already he has done. I mean, it's perfect. And like this, you also see with whom you already spoken, with whom you might speak in future, or whom you don't want as investor. And it's great then when startups can share this between each other. Here, I also prepared some links.
I'm so sorry, I hear, but I not have good internet.
Vladimir, you're here, perfect.
Yeah,
telling
sure.
that you showed this your table and it was very good. I mean, you've done your homework as startup and gathering all the information that you have done. And it's
Thanks.
what all other startups may consider to do. It really helps for the future. And here in this presentation, I just will show you in the end. I prepared a list of active VCs. It might be helpful, right? Open VC apps. Let me see, maybe we can go there. So I prepared some useful resources, right? This is article on active VCs in European states, which you might consider to see. It's 87 lists and databases of different VCs. I'll just show you, right? Because I want you to have something useful after this lecture, not only presentation. So check it. So global VC list, like open VC, and you will have, you can download the whole VCs, I mean, here from here. Grid, this is database of free list of angel investors. So have someone worked with this resource before, open VCs. A VC list in the United States, those for you who are interested, you can download it there in the Airtable, right? Other VCs in US. And here you have all types of VCs, like by topic. You have some European, you have investors in Africa, Australia, Singapore, Dutch. So basically country by country, depending where you want to go. So I hope it might be useful for those of you who want to explore them. As those VCs are checked, and it's kind of more or less fresh information. So maybe you have some questions at this point. I will go back to our presentation. Just let me see. I want it to be like more real life mentoring, because many things you can read, and there is also very useful things like venture capital evaluation criteria made easy, right? What they like to invest on every stage. This resource I also highly recommend you, as you will see what prefer later stage, what kind of things invest, like attracts VC on early stage. It's very structured information. That's why I'm not going to repeat it, but want really like to have it more more fun. Just let me see. Different type of venture capital. You can see here in this article. It's all will be sent to you. Evaluation criteria on growth stage, on early stage, on later stage, and factors that affect actually venture success. So it's like very, very structured information for your convenience, as those of you who want to read. That's why we're not going to repeat. We just want to share what we've done. I see someone is writing. Hello. Okay, guys, let's go further to VC stories. So tell me, have you ever been already in some weird situation with VCs? Someone like this, you go to VC.
Which
Some strange or weird situation. I'll try to show you video if I can, like this.
I can maybe share one situation. It seems that VCs, they have like the main goal. They can enter their, like, to invest in startup, and they have also exit strategy. And there is almost the conditions that necessary to discussed at the beginning, because now also they have like time for the investments, they have time to exit, and definitely they need to earn more money. And what is the value? It could be if they have the opportunity to open door to another companies. But definitely, I have also the question, and probably what could be the better investor, family office or VC?
Depending on expertise, because family office sometimes have already good investments in manufacturing that might be useful for your startup. For instance, you hardware, and they have some kind of either retail or some manufacturing where you can use your startup, and then it could be good partnership. But maybe VC can have something good in their portfolio that can give you synergy. So you always see what they can propose you except for money, right? What they can give you.
But okay, if you can go, let's say, if you have the technology and we can go to the different market segments step by step, and we can penetrate big companies like global companies to bring the solution to the market. Why we need to go to the VC if
It's
the big?
then it's better. There is a rule. If you can go, the best investments, it's not investments, it's contracts. So if big company can give you a contract without VC, it's perfect. Or then you are diluting, you just get this money from big contract and you can finance your operations like this.
Yes, that's exactly what I need to hear, because actually that is almost direct way to the earning money and like to generate the revenue. So because the VCs, they can support, but definitely if you can get funding from global companies, collaborate with them and receive collaborative contract with them, it's much easiest way and direct way to earn funding.
It's much easier, it's better in many respects, because then you keep control on your innovation, the company. You see, the VC industry became popular, I would say, or like really growing after 2008, right? After previous financial crisis. So it's like started really booming. I mean, it appeared earlier, but the VC became popular as alternative to market with securities and so on. And then in 2015, 2016, and 17, United States really were printing money just to speed up their economy, and partially portion of those money went into the VC industry, and it created some kind of artificial, right? Europe was watching on them and trying to pick them up. Oh, we also need this venture industry, we need innovation, we need finance it from European budget, from European Commission, because we also want to boom innovation. I mean, it's in a way right, but for us, it's crucial to understand their nature. Okay, now it became a bit more fashionable, right, to take VCs to get your valuation. But if you can make money without it, or you can take it at later stage, why should you take someone into your equities or in the management of your company if you can't be without it? So of course, the first source and the best source for company is your client's money.
Thank you so much.
And the more clients you have, the more expensive you are, right? You generate revenue, your valuation is much higher, you can demand more from the system. So definitely always look like the traditional or like recommended source of funding. First think of clients' money, then maybe, if possible, take some debts, and only later, the third one is some kind of equity. But as again, it's now becoming like, I would say last 10 years, last 8 years, when everyone, oh, I'm so valued, I want to have a deal, let's make rounds. And it's like VC business, VC industry became a little bit like fashion business, or like, I don't know, like pop business, right? They are so absorbed with rounds that many of them not absorbed with delivering results, and with actually they're thinking about valuation, but most of them are like bubbles. And if you're building business, like a real business, if you're making money, if you're having companies and clients, it's really much better, And in the end, VCs will come to this kind of business. So that's why We explaining how VC works. It's our topic for today, but it's not like we are pushing you just to take someone's money. It's your
Yeah,
decision
actually,
and you should be aware of it.
yes, actually, people with money, they put fund into the such VC fund, and actually they only manage such fund and control the profit of using such fund. But almost if we can find people with money who can invest on angel stage, and after that we can go to the global companies with the product, it's much easiest way to generate profit and to achieve the investment as well, like more strategic investments and VC.
Absolutely.
Thank you so much.
So I think several startups here from this cohort said that really we want to bootstrap, and we will speak with VC, but we want to bootstrap. And actually, it's also great if you can, if your business model allow you to charge your clients, and you already found your niche, you found your product market fit. Why not? Then bootstrap and grow. Just if you can scale up at some point without money, first scale up and then take money, and you'll see how it goes. There are some types of startups when it's hard to do it without intense marketing, right? So then you decide yourself how you want to proceed. So what investors are looking for? But first of all, there is a tricky question. Am I attractive? What investors usually looking for? Who consider himself or herself to be attractive startup? So what do you do to become attractive? Who is sexy startup here? But don't be actually shy, guys, if possible, just because I really liked some of your startups, really. I think you tend a bit to underestimate yourself. Yes, Lucas, please.
Well, I have a startup at the idea stage, so I don't know if you're interested to hear about this.
But you can sell it so that it will sound like, next Facebook.
Okay, great. Okay, so would you like to hear what is this about? Yeah.
Yes, maybe a couple sentences. Please make us one like elevator pitch, 1 minute, but sell us so we all will invest in you.
Okay, I will enroll you in this. Okay, so what is the startup? Startup is about contributing to societies. And what I mean by this is by the two groups which are crucial in the creating process. The one group of people is coaches. So the different type of coaches, the life coaches, spiritual coaches, relationship coaches. So this is all like everyone at some stage of life needs some advice from. And the other group is the artists. So what I mean by this, they are people who are very creative. They create, say from different areas. So let's say it can be singers, actors, painters, poets. And from these two groups, they are able to provide the services online as much as face to face. And what I found out is what is missing is that these two groups, when they cooperate and they create the product and services together. So if you can imagine that the product, which is life coaching supported by the amazing artistic like songs between the coaching and some painting about, let's say, the area which are working for with the clients. And what the idea is that the both part of the mind, the creative one and the logical one, are activated. So
okay, Lucas, I am a VC. Where is my fucking money? How do you do money?
How do you do money?
Okay, yes, we didn't get. I was listening for 2 minutes and I didn't get. Where is money? My money. I see that a lot of creative people partying on my cost.
Okay, so how you create money is a cross-selling with coaches and the artists creating the products for the people who are joining the platform, who are looking for the coaching, And so this is how you create basically money. So
And
this is
your business model is commission, right? Yes, for platform.
sorry.
What is your business model? Commission for platform? Yes.
Yeah, it's
How do you make money? How startup make money?
I do money from the commission from the coaches from what they make, and also from the account payment for the account from the members. So it means the people who are looking for coaching. So if they choose the more advanced account, they pay for the monthly payments. So yeah, so this is basically what it is.
Okay. So guys, who would invest in Lucas? In creative people? Any reactions? I mean, it doesn't look like people excited. Maybe only Olga will something, or maybe just participate in platform, sending something. Okay.
I suppose maybe there is a different scenes. It depends of the goals. Probably to invest money and get more money, or for example, to invest also in the team in some high technology scenes, and there is like almost a prestige or image of the investor. It could be, but almost always to do money. My opinion.
Yes, I mean, it is.
And
Right.
if you talk about the actually, if I'm attractive, it's almost team. It's almost the market, the technology, or the product, and definitely, it should be also the business model and how the investor can get money back.
Basically, Ruslana help us to describe next slide, everything you see. So first of all, how big is the market, total aggregated market? What is the business model? What is your competitive advantage? Fast growth and path to profitability, management or quality of startup team, and actually how you feed the market. That's everything that you told. Thank you, Ruslana. I mean, it's perfect. And one more question is very favorite question of Y Combinator team. Y Combinator is actually, the story behind them, right? It's one of the most popular accelerators in Silicon Valley. It was founded in 2004, and probably it has the biggest amount of unicorns and decacorns in their portfolio. But the secret of them, of course, that they are actually situated right in the Silicon Valley, and they have access to all those startups who are coming, and for them it's easy to be just in the heart of innovation and participate in all those movements. But what I had a question regarding them, and why? So they usually ask startup a question: what is your unfair advantage? What does it mean? For unfair advantage, not competitive, but totally unfair. So basically, why they are sure that you will survive among all other startups? Why are they supposed to invest exactly in you? So this is tricky question that you have to think. What makes you to survive all difficult situations or upcoming troubles? And maybe unfair advantage could be your access to, I don't know, you can lobby your innovation with government or whatever. You have uncle with Microsoft who will help you or whatever. There must be some tricks that will help you survive in tough times. I mean, it seems really unfair, but they have a special lecture on the unfair things. It doesn't sound like traditional market economy when everyone is equal. In startup world, it's like a jungle. Yes, it's not like for everyone. But thank you, Ruslana, for pointing investment criteria. So investors look all of these things.
Not at all.
Yes, everything that you told, you actually pointed all of them. I wanted to show you a small video. I hope I will be able. How investors speaking with startup. Let me see this one. Hope you can Let me just see if it's working. If not, I will send it to you in a second. So much here. Hard. Okay, it's not sharing. It's hard to share it when you have so much things open, but I will send the video because it's example actually how investors might behave. And we also need to speak about investor behavior. So sometimes investors might give you negative feedback. What learnings you might find from it, yes? What kind of reaction you should experience? Because those who are experienced in speaking with investors might be disappointed, right? If you have only 5 or 6 contacts with VCs before and you see and all of them are negative about you, what to do? What are your learnings? How to react? The point here, you know, that they look for a bunch of startups, 100 startups, but actually you also look on hundreds of VCs. And when you're a more or less experienced startup, you really don't give a shit if they really don't like something. Or they can give negative, like very much useful criticism of startups. Many investors, like professional VCs in your industry, they have seen similar ideas and realization of these ideas. And they sometimes given really, really good directions where to pivot your startup, what to change, or maybe you can change your business model. So speaking about any investors, you should try to get some good feedback, or I mean, bad feedback, any type of feedback that can be useful to your model. Like make sure you listen to them, right? Or make sure it makes you've heard their comments. Maybe you have to change something, right? Better early fail. Like it's really like a very important rule in startup world. Better to fail early and cheap than fail in later stage when you understand that you already developed this MVP. It's so expensive, and you already burn all your money, and you still cannot go to the market because sometimes for some reason it doesn't work properly. Maybe some of you experience such situation. So we try to develop such attitude in startups that negative feedback is the most important one, right? Even if it's negative, maybe you can find some values. Yes, Naomi, please.
Yeah, and I would not call it negative, but more like I don't have the word, but even if it's negative, it's so valued that it's valued even more than the positive ones, because you know which direction to go, where to improve. And with the positive one, you will not see that hole in your, I don't know, business model or anything. So it's like we did it, for example, with investors by we redefined our business model, our market, together with investors, like together with people that we know they will not invest in us now, but maybe in the future, yes. So it was like they first, it sounds like they doubt us, but then they wanted to show us of the right direction, right? So it's actually very important to not to see it as negative, but more like to be open for this feedback, even though it's feedback that you don't want to hear, but it's so important to hear it.
That's the point. Even if you don't want to hear it, sometimes important to listen, because they might give the direction for your thoughts, you know. And there are also such types of startups events called like startup crash test, you know, when you come there and a bunch of investors or probably corporates or maybe even potential clients are just sitting there and just criticizing your startup. And you have to have real balls, you know, just to not feel like some negativity, but try making notes and see what can you improve, what can you done, or what can be done in the business model or on your approach. Because usually you don't criticize the founder, but you criticize the invention or the business itself, the business model. So it could be exciting experience. We do it with our startups, and usually they found it quite insightful, despite of they are sitting and listening just to the critics, but later on they really have some kind of insights. So this kind of investor behavior, be aware of it and use it to your maximum, right? So maybe anyone else had some troubles or some criticism from investor on experience, and maybe can share with the team.
Not with the investors, almost, you know, with the lawyers, because sometimes your lawyers can do complication in such investment agreement, you know. But with the investors, it's almost, it also depends on the investors, but almost fine. But sometimes when the lawyers involved in the process, they can make it more complicated, you know.
I think it's their job, you know, they always appear and make our life more tough. I mean, it happens, especially when it's divorce or some kind of trouble, they make it double.
Yes, definitely. They can, like, you know, to make such agreement more complicated to both sides, not only for the investors, but also for the startups, and opposite way. And sometimes the investors don't want to have any also complication with that. But sometimes lawyers, they have knowledge and they try to protect investors, and they almost think that if the investors gives money, that probably startups will not satisfy the expectation, you know, and that's why there is a big problem, I suppose, when the lawyers involved in the signing process of the investment agreement.
But unfortunately, we cannot go without them. So maybe the only way is just
Definitely,
to
yes.
develop some lawyers that you really trust. I mean, we had really many situations in our case, as like my main role is usually M&A advisor, right?
We did it really simple. We took the lawyer from the startups, we took the lawyer from the investors, and also the investors and startups, and discuss everything, all conditions, and exclude any complication, you know, be like the investors give his expectation concerning, I want to make it more simple and without any complication. The same as the startups. They announce the same thing, you know, so that's why it was much easier. But at the beginning, it's almost complicated, you know.
You know, when you do big M&A deal, sometimes you have to pay lawyers like 500 euros per hour, and they create such a mess, but it's unavoidable to do it with them. But it's true, you know, in States, there is special type of agreements for startups, like 2-pagers, just to make it really simple in the early stage. So if needed, we can also send you such examples that maybe you can use it there. But it's created for Delaware, yes, for their legal environment. And in Europe, people usually use their local agreements.
Yeah, it will be helpful if you can share such agreement.
We had it somewhere. We had it for our bigger program. So
Thank
guys,
you so much.
had some experience with investors or maybe some troubles. Adam, who is Adam Kiss? I love the name, but I think I've never met you before. Are you here? Or maybe someone else can just share some investors' questions or investors' experience or concerns or some painful questions.
My main really pain that the investor tell your startup is really cool, your solution is really
you know, I made special slide for you, you know, look at this investor. I mean, that's the man you recognize, you know,
yeah,
it's like,
it's my
yes. Unfortunately, I don't know how to make life easier, you know, because it's American style that they really, oh, it's great, and then they disappear, you know. But it's also here in Europe also becoming like this. So I would be more grateful to hear that, I mean, you're doing some shitty idea, you know, just relax. It would be easier for me to understand, or maybe just real constructive criticism, like we discussed before. But unfortunately, it is what it is. Sometimes you can chase them, you can force them to give feedback. Sometimes it is like, you know, maybe they came for one reason, or maybe one more trick, important to know what's happening here a lot. As we've seen before, in some funds supposed to have limited partners, right? Before investing, they have to gather money. But what they do, they first try to create pipeline of portfolio companies, selling that, oh, we have 10 companies to invest, and those companies are really cool, we pre-select them. And they create this portfolio of companies, promising that they will invest in next month or two, and then they disappear and they go with this portfolio and try to fundraise themselves. And startup is waiting, right? Startup is waiting for money. So we've seen this situation many times when actually empty funds come to startup, promise them something, then they disappear, and then 9 months, 10 months, 1 year is gone. You are waiting for the deal. They are picking your brain. You speak with lawyers. They keep evaluating you, but nothing happens. And then we, through professional connections or rumors, understand that they don't have money. Actually, they cannot invest. It happens like this as well. That's why it's great to have such networking and make due diligence, like mutual due diligence for your investor or for your potential fund. Otherwise, you might just lose your time with people who are not able to invest for some reason, right? This happens. It's not like all people who are going to invest are ready to invest or have capacity. So I also created this slide. You choose your investor, not only investor chooses you, but you also. You, how selection of venture capitalists, right? Approach adopted by VC. What does it mean? Do they help the companies or not? Do they participate or not? Or maybe they really want even this to have their team member back on your head every week, you know, and you have to report for them. Or maybe you can report them just once a month, or I don't know, even half a year. I mean, it's very different, right? How to manage this relationship with VC. Flexibilities in deals. Exit policy, one of the most important, when they want to exit. Do they want to exit in 2 years, or they can be with you like for 6, 7, 8 years and grow your company? So you always ask them, so what is your exit policy? What is how you see the deals? How weak are you in making deals? Number 4, I just mentioned you before, fund viability and liquidity. Do they really have money, or do they just promise? This is a tricky question, because what's happening now with Ukrainian, for instance, I know this ecosystem, and with Polish one, because I'm active now here, that you have hundreds of funds, but basically 10 of them have some money to invest really. And you as a startup trying to approach them, but no reaction, right? But they already had kind of burnt out. And this happened a lot here because those ecosystems, they are still in the process of learning. So I cannot comment on the Czech ecosystem or Hungarian one, but as I understood, there are just also several good funds that are there active and they can invest. So that's why it's great for you to know who is who. And that's why actually you're going to World Summit or any kind of other events just to learn who are those people. And in the beginning, when you are just starting your fundraising journey, it seems like, oh, it's hundreds of funds. Probably there are some money and it's easy to fundraise. But actually, when you go from event to event, or if you go through the database in your country, you will cross some out and you will see that there are just several active real funds that might be helpful for you, or those who are in your industry. So it really narrows your funnel. In the end, you will know most of them who are really important ones. And what happened in the in Ukrainian ecosystem, for obvious reason, many funds escape. In Polish ecosystem, it just happens, and in 2-3 years after creating fund, they couldn't perform for many reasons. And then actually the money are gone. There is nothing to reinvest. And basically, the funds are gone. So those who were active in 2020 or 2019, they are not active anymore. That's why if you go list by list, I mean, fund by fund, you'll see that there is less this amount of real active VCs than you expected in the beginning. So what else? What else we have to see here? Track record of VC and its team. Yes, it's important question because first of all, there's supposed to be some kind of chemistry between you as a founder, of you as an innovator and creator, and between VC fund. Because if you see those kind of, I don't know, weird, arrogant people who are telling you how to live your life, who don't have your expertise, and they are trying to teach you how to develop your startup, it's not always helpful, right? I know that many of you here in this cohort have PhDs and you're really deep in your industry. And for instance, me, I have only investment background. I'm not a physicist, I'm not a doctor and so on. So I cannot teach you. I mean, I can teach only business component, but not innovation, for instance, not something valuable to your industry. I'm trying to empower in startups with some kind of connections, introductions and so on, but not really picking their brain. And this you should be aware when you're choosing your VC and your potential partners, as well as your partners for the business. This one was things to discuss. Any reflections, any ideas or comments on this part? I mean, you guys ask something because I need to make breaks and drink some water. And not fun when you by yourself. Okay, this slide about current situation in the world. Huh? Who wanted that? Okay, so something misconnection. Okay, world in 2023. So as you've seen recently, I mean, I decided that it makes sense to touch it because it's widely discussed and that there is some kind of slowdown in venture industry, right? This is this graph, second one. It's number of exits in American venture industry. And you can see the slowdown, the expectation. So they changed their approach. If in 2001, 2000, even 2001, they were active, they were just throwing money into new projects. Now they're starting rigorous due diligence, even from early stage, from Series A or even post MVP. So they're just checking everything. They're trying to be really tough on startup and understand what they're investing. Will it help or not? It's not clear because, I mean, if we're in downturn of economic cycle, it will slow down. So that's why it's really great to when you can relate on your customers and develop your startups without venture money, but just be aware what's happening. So even if valuation last year were much higher, this year you still can fundraise at lower valuation. And I also added this graph about like expected recessions. Yes, if you're going to another market, in some markets it's like 75% that it will be definitely deep recession. You know, it's estimation by Bloomberg, sources Bloomberg. This is for you just to understand and to be aware that it's not something wrong with your fundraising strategy or your startup, but it's also some situation on global economy, and venture ecosystem is deeply dependent on it. I would love still to have your reflections on our today meetup, whether it was something useful on you or maybe you have some questions. Maybe those people who haven't reflect, haven't speak. Maybe Vitaly, can you give your some feedback? Was it useful for you, or maybe you have some questions left? I hope you guys not sleeping there. You're supposed to show off. Or maybe Daria, Vrobel, are you here? It's a remarkable startup. They came with number of phone for mentoring session. You know, I opened Google Meet and there was like bunch of people. So you guys show up now.
They actually online me, but at this point I don't have any questions.
But was something useful or maybe something, I don't know, what is applicable to your situation?
We haven't started talking with investors. We are right now at the situation that we are get in contact, get to know each other, but not exactly the valuation of our startup yet. It's just beside of us.
But hopefully, guys, you will grow because I remember your startup and you can get some customers. Okay, thank you. Lucas, do you want to tell Lucas Rezanina how to pronounce correctly your name, your last name? Nordics. I know you've named a startup.
Yes. Yes. So I pronounced that Rezanina, and it's not easy now because I have kids around me. But I try our best. And yes, thank you, Elena, because there was a lot of information is like hidden from the startups, I would say, from about the VCs, and I have made some screenshots if I could, and some information that are just valuable, and I didn't know exactly how does it work in the VCs, because maybe I know the side of the startup, but I'm not sure about the side of the VC. So I think it's valuable. I don't know where you found this information or how you collected all these main things. So it was great.
In fact, it's just introduction to the VC world, you know, because we work with many VCs and we try to study them here, like in Poland, in Czech, to see who is who and how they work. And then when you understand the logic of VC, what is logic behind their minds, it helps you to create the deals, really. So if you have some kind of questions, guys, ask, because usually we have 6 lectures of VCs: introduction to VC, then legal terms, what you should be aware, managing your cap table, then actually making valuations, and so on. Here we have only one conversation, and I want it to be useful. So that's why all your reflections, they also help me to answer the questions that this particular group might have. Who else? Who else? Adrian, do you want to comment something?
No, it's everything was perfect. It was very interesting.
I want to ask, what's the faster deal in your life, really? What in your startup, or maybe you know the nearest your surrounding, a faster deal with investor?
The fastest deal was actually when I was M&A advisor, not like finding investor, because when two sides came to me, both sellers and buyers, and one wanted to buy a plant, really like a real production distressed asset, and they came to structure it. So they needed to understand the valuation. It was my job to make calculation that actually makes both sides happy, and to organize the legal structure, how they should transfer the money. So it was the fastest deal I can recall, and it was done in 1 month, really. It's really quick, and both sides were eager to pay us as commission, so it was a good, non-problematic deal at the time. But sometimes you work on a deal. I mean, the biggest failure, it's also M&A deal. It was like we invested almost 2 years of my life, the life of the whole team, and we were selling big manufacturing to family office. Investor was from Turkey, asset was in Ukraine. The size of deal was like 200 million. It's really big one. We've done all legal structure, and we had the most expensive lawyers from the best, both sides. From our side was Baker McKinsey. From another one, so was also reputable, expensive firm. So we already wasted a lot of money. We created legal structure. And then in the day of signing share purchase agreement, basically signing the deal, when the rights of transfer rights supposed to occur, both owners somehow managed to quarrel, and it collapsed. It's collapsed just in the day of signing. It's like it was really disappearing experience. When you invest in so much money, time, especially like 2 years of your life, and they cannot agree. The point is really the speed of deals. I will just finish. So why it's more exciting really to work with American funds, because they take their decisions so quickly. If they see good opportunity, they just grab it. And here all funds act like private equities. Even if they're early stage, they still act like later stage funds, like private equities. They demand the whole due diligence, financial modeling, legal check, background check, and so on. And it takes so long that you cannot develop your business with a speedy way.
Many times I heard that United States investors invest only if you're in United States. Is there the right? Can we, for example, be on Poland and fight the United States investor not relocate in United States?
Yes, you can, but it should be specific startup. For instance, there is a company, it's a quite famous case, Deposit Photos. There are 2 companies in the world that send in pictures, like photo stock, right? There is Shutters on, it's listed on NASDAQ, I believe, and there is Deposit Photos like this. And Deposit Photos actually a company that was built in Ukraine. The founder is in Cyprus, and it was bought and invested by Americans. But the point is that they have such a product that it's everywhere. So physically, he even doesn't speak good English, you know. He never bothered really. But because of the product is everywhere, you know. It's like you can see how it's traced. It's like Facebook, for instance, everyone uses it. In your case, Alexandra, it will be much difficult because you have tables to present, you know. It's not, you have to speak with their market, with their retailers. So there are such cases when you are not in US, but they can find you, overlook, and invest. But the point is another, that US is such a big market. If you are there, you grow like much faster.
Okay, thank you.
So any other questions? Who else haven't spoke today? Yeah, I think we even never met. Can you please show up, please? It would be my pleasure, I mean, to meet you.
Hello, can you hear me?
Because probably, yes, I can, perfectly. Because you probably work with Gergo, with Tomas, and that's why I cannot ever met you. But please share your reflections on our program, lecture, or maybe questions, or it's just a pleasure to meet you in person.
Yeah, it's a pleasure to meet you. Thank you. The lecture is interesting. Yeah, I've already seen several of the similar lections, so they were just pieces new for me. I really like these practical parts when you give us the links for the lists of VCs, because that's something that we were struggling with, where to filter and find the best connections. So
it's 87 list of VCs. It's like
yes,
it's all databases connected in one place.
That's really amazing. You should tell me this like 9 months ago. It would save quite a lot of my time.
They already are organized and structured, and even you've seen by country or by region, or sometimes by industry. They are there. Some of them, of course, for subscription, but it's like $50. It's less than half a year of work, right? So it might be helpful.
Yeah. So thank you. I don't have any questions at the moment.
Okay, I wanted really to make it something like more practical, you know, not just overlooking and basic stuff or some gaming, but to give you some value from this. Who haven't spoken? It was us. Yes, Vitaly, are you here? You never speak with me. I know that you know me, but I think you're sleeping, man. Oh, hello.
I'm here.
How was?
Thank you. Thank you for lecture. Very interesting and important for me. I will be practice your information.
So then the coming to World Summit, what are you going? The idea is there to hunt for VCs and to interrogate them. So you, as you already had this lecture, you be in active position. You hunt them and ask him, you guys, do you have money, or you just making your cheeks, you know, showing that you are so important and so rich. And you there will be able to make this list of VCs. You will see them in umbrella, and you can actually make most of the event. I will send you the links and follow-up email for this lecture, because you will be able to read them, and I will send you some tricky, funny videos as we see speaking to startups, which I couldn't show because I have too much on my screen. So if basically you're happy with it and there is nothing to comment, then probably we can close the lecture and our meetup. If you have something, just let me know. Any reaction? Then thank you. Thank you for today.
Many
Thank
thanks.
you.
There is a recording that I will share.
Okay.
And see you with Marina on Thursday. So she will speak about messaging and communication. Maybe you have some particular questions regarding marketing, so please.
Great,
Well,
thank you.
with this, I'm switching off recording. Thanks and bye. See you soon. Those who want to stay, you can stay, and maybe to ask some off-record questions, you know. I'm trying to